Morning, guys. Good afternoon for those in Europe. Let me know if you can hear us and see our screen. Please post a comment here. Today is going to be a very good one. We're going to share a lot of information on how to leverage the data. But yes, before we do that, please let us know if you can hear us. Yeah, great. So let's start with a very short disclaimer, just a few seconds, and then we get started. All right. So today we have our team here. We have Patrick, we have Doc, and Punk. So we have different type of trading strategies here. So we're going to go over how to handle a day like yesterday. So yesterday we saw a big sell-off in the market. The futures were down 5% in pre-market, and then the kind of market bounced a little bit back. And today seems like to be positive. So what we're going to do today is we're going to show you how to leverage some of the data sets that we provide to be able to prepare yourself for a day like yesterday. And then we're going to pass it on to Doc and Punk that are going to show you from an options seller perspective, how can you manage the day like yesterday, what type of information you look at. And then we're going to look at from a scalping perspective by looking at Patrick's roadmap and strategy on how you can prepare yourself for a day like yesterday, if you are scalping or if you are a directional trader. But let's start basically looking at the data. So first of all, can you predict the future? Can you predict like a day like yesterday? The answer is clearly no. But how can you use the data to kind of like understand, hey, why is there a shift in the market? What's going on there? So let's look at some of our charts, some of our models, right? So the first step we want to do is let's look at the data from a few days ago. So we start with the matrix, and we open up the SPX data. So the matrix is essentially a dashboard that will look at all the option chain and will show you how the market kind of like is positioned on any given day. So if we look at the 31st, so a few days ago, you see a lot of green bars here. Let me open it up. So the first thing you want to look at is the top here. You want to see the total exposure. Whenever you see green, it means that JAX and DAX is positive. So whenever you see a green total exposure, it means that we are in positive gamma. We're going to explain that in a second, what that means and how you can prepare for that. You also want to look at the different kind of like data. So how did the JAX change over one day and the DAX? So we see an increase in positive gamma compared to the previous day, as well as increase in positive gamma, positive delta compared to the previous day. So overall, this was the 31st, right? So what I did here, I went into the matrix. I went back to July 31st. But let's go back to the 1st of August. So the 1st of August, we see a completely different picture. So like a few days ago, we see like now we are a strong negative JAX. So from one day to the other one, we see like a complete shift in the gamma. Delta is still positive. And then you can see basically how the JAX change over one day and the DAX change as well. So we see the shift there. Then we can also go to the next day and see how that changes too. So we go on August 2nd, right? So let's go back and see here. So now we are very, like this value is actually going down again. You can see how the different expiration are in negative or positive. You can see the data and you can see the different levels here as well. Then we can look at other things. So let's go to our swing trading model, right? So let's open it up and let's combine a few data sets. So let's go back to the 31st. So for those who are not familiar, basically the swing trading model was introduced in the middle of July. And essentially what the model is giving you is a price volatility band for the next 5 days. It also gives you a directional bias. So whenever you see a green lower band here, we are actually bullish bias by looking at different algorithms like gamma, delta, and other option metrics, as well as momentum. So on the 31st, we see that the lower band is 5,400. Then we have a risk trigger of 5,628 with the bullish directional bias. But then we move to the first, and then suddenly the picture kind of changed. So we see that now we have an upper band with a red line here, which is a shift in bullish to bearish bias, right? So now we're seeing a bearish bias there. We are also basically looking at the 2nd of August here, and we see kind of like the same story. So we're still in a bearish bias, and then we can move to the 3rd, and we see basically now we are again the risk trigger moved down all the way below 5,000. Another thing we can do is we can look at the skew. The skew is our risk reversal skew, so it's looking at the volatility of the 25 delta calls and the 25 delta puts. So obviously we want to measure the spike in volatility, meaning that the puts are becoming more expensive. So that means that the market is buying more puts than calls for the 25 delta, so out of the money puts. So as you can see here, if we go back to the first, we see kind of like a shift towards kind of more the call side here. But then if we go back to the 2nd, we see an increased spike in put volatility at the 25 delta. So out of the money put are actually becoming more expensive than out of the money calls. So the market is kind of like really starting to protect themselves on those out of the money puts. The next thing we want to look at is the main chart. And this is a very, very important tool that we can leverage. So first of all, the main chart shows you at the top side the levels, so core resistance, put support. In the middle section, we see the implied volatility. So we see also that there is an increase in implied volatility versus historical volatility. We also see the IV rank here. But the very important part is this lower part of the chart. So let's go and let's look at it in more detail. So here what we see is the historical net gamma exposure and the historical net delta exposure. Then we see the forward-looking net gamma exposure and the forward-looking net delta exposure for the expirations in the future. So whenever we see kind of like this going below 0, you can see how kind of like that kind of like predicts kind of like a down move. So whenever the jacks and the decks start to shift towards the downside, we see also that the price start kind of falling. So again, this is another good metric that you can use to understand how the market kind of like is positioning itself and what's going on there. So I'll pause there, and let's see if we have some questions, and then I'm gonna pass it back to you, Doc and Punk, to see how you are looking at that and how you kind of position yourself today.
I have a question for you, Fabio. If we have no questions from our community.
Yeah. Not yet.
All right. So can you tell us some easy steps? So people always loving routines. So you was going through many steps to show us how we can read this and how we can predict this. But for a daily routine where we can have maybe less than 2 minutes, what you would say, what we should do, what should step 1, step 2, step 3, only simple 3 steps. So that we can looking what was happened in the past, what has happened now, that we get a clear picture, that we get only a feeling. So remember, so for us it's really important, and I think for every trader, to get a feeling for the market, what's going on in the market, especially when you came maybe now from holidays. We have summer, you was in holidays 2 weeks, you have no idea what's going on. To go easily in our board and get really fast some overview what's going on.
Yeah, that's actually an excellent question, Patrick. Thank you. So the first step, I would say that if we go to the bot here and we go on the left-hand side, and let's look at the SPX, for example. So on the left-hand side, obviously you guys can use the bot, but we also have channels that auto-populate every day with data. And the order of the data is actually intentional. So we don't just post charts, but we actually post it in a way that you can use it to follow a routine. Exactly like what you were saying, Patrick. So the first step when I log into the morning is I would look at, okay, let's look at the data. Let's start from the SPX. We can also do it on stocks and futures. But essentially, what you want to see is a snapshot. Okay, this is like liquidity snapshot. So what's going on today? What's the expected move for the day? Are we in positive or negative gamma, right? So condition of gamma, this is going back August 1st. Is the momentum bullish or bearish? This looks at technical analysis, moving averages, crossovers. What's the implied volatility versus the historical volatility, right? What is the IV rank? Then I want to look at, again, my main chart, the two that we showed you, to understand, okay, so how is the historical jacks? What is the market? Like, where is there a high, like jacks in the near expiration? So like in this case, we can see that the market is really like, there's a lot of large positive jacks in that expiration there. Then we want to look at information here. So this is a table with all the key information. So open interest, put open interest, put core ratios, how much jacks is expiring. Then I can open up my levels. So I can go on my trading view and I can actually look at my levels here. So for the day, you can prepare yourself looking at what are the levels for the day. Then I can actually look at positioning. So this is a very important chart. So it's the net gamma exposure for all expirations here. So first you want to see, okay, on August 1st, we still had a lot of bullish positioning on these strikes here, but we started seeing like piling up some bearish positioning here. You also want to see, and Doc is going to explain more on maybe this one, you also want to look at different expirations, right? So based on your time horizon, so if you're a day trader, then you might want to look at 0 DTE option. But if you're more like a swing trader, then you might want to look at, hey, what's going to happen at the end of the month, or what's going to happen in the next monthly expiration. So you can actually look at these charts too. Then you can look at the swing model. So as we see, this is the swing model. This was for the 31st. So we see like on that day, we saw a bullish bias there. We also have a 20-day swing model there. The matrix, this is the one that we showed you. So again, open it up, read through it, look at the different data sets, look at, the levels for the expiration. And then obviously you can look at more advanced model like volume and open interest, for 0 DTE, net delta. So there's a lot of other models that we have. And then obviously the skew is very important. This tells you, is the market buying more calls or put? Like, is the implied volatility of calls and put increasing, and so on? So that can give you like an idea of the sentiment and how like you should look at the market. And then obviously term structure. Then you can go back in time. So for example, here we see the history. We can go back in time and see the past data, but we can also do it through the bot. So we can go on the bot here and look at our net jacks and then scroll back and see, for example, the change in time. So as we can see, we see a big pile of negative gamma exposure in the recent days. A lot of it on the first, but if we go back to the 31st, we see we have a lot of positive gamma there. Let me know if that answers your question.
Yes, I think that's good. And for all the people who have maybe not the deep understanding about what is all this meaning, like high volatility, implied volatility, and all this stuff, we have a nice library. We have also our academy where we cover many stuff. So I think that's a good point to start the day, to look all into this. And then I think it's really important, go on your chart and look on your chart and what the levels are telling you.
Yeah.
Good point, Tim.
Yeah. And Doc, like I'll pass it on to you. I don't know if you want to share your case.
Yeah. I have my screen share now. Actually, you see what I'm screen sharing?
Yeah.
Okay. Hi. Okay. Hi, everyone. So, and I'm just going to take it from here, almost an answer to Patrick's question. What I look at first I look at a couple things right away. First, I look at the multi-expiry to get an idea of the state of the market. Trust your eye. Your eye is a good filter. You see we're in a sea of red. So the bias is downward. And, we kind of already know that. Now, even if you're mostly a day trader, I still want to look at the multiple expiries. Think of it as in technical analysis 101 or price action analysis, multi-time frame analysis. The exposure and the bias out till Friday is going to influence market makers hedging today. And so I like to get a picture on all this, and we see, okay, today we have a bearish bias, and we're kind of buried in all these in the money puts. But we're about to, with the volatility is changing, so this could end up being a tailwind, not a headwind. And for that, we kind of have these key levels here. We see this 5180-ish level. Yes. Then here's oil expirations. So we could see if we went back a few days, like Fabio showed us, this was all green here. Then it was almost all red yesterday. Now we're beginning to try to shift, but we have to kind of get over these levels here to kind of be out of the woods. All right, now I'm going to look at the swing model. So I'm an option seller more than a buyer. So what I want to look at first is where might the safe levels be to sell options? And hopefully, this is not the time or place to explain option selling other than to say, sell a call or a put where I think the underlying is not going to go. So if I were to sell a week out, I'd want to sell below 5,000 and above 5,400. I'd want to be outside of these levels. Okay, now I was looking at VIX today, and I'm sure that most of you, if not all of you, are aware that we had a historic VIX spike yesterday, and along with that, a historic VIX drop. The amount that VIX dropped from, call it 55 to 30-ish, was as historic as the pop. So I want to see where the VIX inflection point might be. And we see we have an inflection point here at 30 coming up. And if we look at the overall complex of VIX, we got this level here at 25. So I first want to see VIX get below the 30 level. Then I want to see it longer term get below 25. Quick explanation of why. I'm assuming there's some familiarity with options makers hedging, but I'll throw in a quick oversimplified version. The obvious assumption is that most people are long puts, that they bought puts. So if I bought the puts from the calls rather. So if I bought these calls over here from the market maker, then the market maker sold them, so he's short VIX calls at, say, 30. So as VIX goes above that level, the market maker has to keep buying VIX futures or correlated products /VX, and that buying of the VIX product causes volatility to spike and then causes ripples throughout the whole chain. And so what we want is for the reverse to happen. If you're a bull, if you're a bear, then you want to see it, keep going up. But if you want market conditions to at least calm down a little bit, we want to see VIX, first things first, get below this 30 level, because remember, market makers bought VIX to hedge this. As we come down below it, they get to sell their VIX, and that's why we get these crazy spikes like we got yesterday. Okay, so there's the VIX complex. Okay, so here I'm looking at that same matrix that Fabio was showing before. And again, trust your eyes. Your eyes are a good filter. You see that we're in a sea of red. But remember, a week ago we were in a sea of green. When the boat is tilted too far to one side or another, get ready for it to turn. Sometimes slowly, sometimes quickly. About a month ago, we had IWM under a sea of red. Then we flipped for a few days, and then we got to a sea of green. So whenever the gamma profile and the delta profile and the customer positioning and speculation gets too biased to one side, get ready for that kind of tell when we might be flipping, just like Fabio showed us on 7/31. We still had the monthly options expiration. Things were still bullish. It looked bullish. Then on Monday, on August 1st, rather, on that whatever that next expiration was, we saw a shift in bias, warning us that this might be coming up. So I'm just looking here, and basically we see we're buried in puts, and here we get to see the levels. So 5,200 we see is a strong level, 5,350. Okay, here's the same skew that Fabio was showing, and just is showing that the demand, that the price of options is expensive. Now remember, volatility goes both ways. So calls are overpriced as well, which is why it's tricky. If you want to take a bullish bias with options, you're kind of overpaying for the calls, so you can be right on the direction, but not get the move that you would like, as opposed to the way Patrick does it with futures. Then you're basically, a one delta, so you're going to get whatever it is on SPX, $50 a point, and you don't have to kind of do those mental gymnastics. The term structure, you can see that we're in backwardation. So near-term volatility, traders are expecting, volatility and, maybe downside to keep up. But within a few days, the volatility is flattening out. But we're still not in a normal shape. Down here, this light blue line is kind of a more normal distribution, more normal call contango, where further out options are more, volatility is more expensive than short-term volatility, which makes sense. Over the next month, I would expect more of a move than over the next day.
And I think if I can add, Doc, if you go back to that chart allows you to compare basically the term structure of yesterday or today with the latest data compared to the previous day, the previous 5 days, and the previous month. So you see how that kind of shifted up quite dramatically over the past day.
Yeah, so 1 month ago we were kind of normal. 5 days ago and yesterday, we see this shift. Whenever you see this kink in the volatility curve, that means there's more in the term structure. That means there's more, there's more volatility, more puts, more people placing bets that something's going to happen there. That there's, now I don't know what date this is, but I'm going to guess this might be CPI day, where we see this little kink here. That would kind of check my calendar, and it just makes sense to know where these days are. Now I'm just going to do a quick look at what's going on the chart today. And Fabio, if you could maybe share the screen where I put in my little morning note, and I also posted on Twitter, and I keep on playing with the format. I'm the typo king, so I run it through ChatGPT to organize it and to get rid of typos. Otherwise, it's kind of a total mess.
Yeah, so let me share, this is kind of like Doc's daily note here. So it's posted in the trading room. This is kind of like how it looks like. and then obviously you share a lot of charts and information based on the data. So here.
And then typically we do this every day in the Discord channel where we go over levels and kind of talk about what we might expect. And Patrick does one at 6 a.m. in the real world at whatever time it is over there in Europe. That was a joke. You're all supposed to laugh. And so you have two different approaches at two different times in the Discord.
Yeah.
And so key levels for today are identified right here. So as an options premium seller, today is kind of a great day because with volatility so high, we can get way below some of these key levels. And what these key levels are based on is based on the open interest at those levels. And if market makers are long or short those calls and the expected hedging response. Big asterisk caveat that market makers are basically net short gamma, which means in general, they're going to be taking liquidity, not providing liquidity. Therefore, moves are going to be wider. Hedging responses are going to be more extreme. So you have to kind of put an asterisk on that. And the 0DTE, forget the put support level. I was talking to Fabio about why it's labeled that way and it's back end stuff. That's a large put level. So that's the level that we need to get over or that we should stall at as we approach that level. And then we have this max move at 52.70, and we have this this minimum move. So you see the ranges are wide today because volatility is so high. And then on days like today, of course, we want to look at what the Mag 7 names are doing. So we have Apple kind of in the middle of its range. We have puts over here at 210. So Apple needs to get over 210 to be able to kind of get some movement. We kind of tried to get over it. We got to this high volume level and kind of stalled out yesterday. So kind of have these key levels and the Mag 7 names in the back of your mind. Obviously, you could trade them if you want, or just how they may affect the overall complex. NVIDIA, everybody's favorite stock, 100's been a key level. And we mentioned in the Discord over the weekend and last week that I didn't prepare the chart, that there's open interest at the SPX, at the NVIDIA 100 call strike in September, at least it was a few days ago. So that's going to be an important delta level. And we we undercut it in that crazy movement yesterday, but we quickly reverted back to it. One more quick word about volatility, IV, fixed right vol, whatever you want to call it, and gamma in general. And this is, Patrick likes to make it simple, I like to make it complicated. When volatility expands, the gamma curve flattens. What that means is the dealer's hedging responses are not that sharp. And the reason is, if I can sort of explain it by giving a hyperbolic extreme example, if volatility is infinity, then any option might expire in the money. If volatility is zero, then we're not going to move at all. And so the probabilities change as volatility increases, changing the deltas and making it and resulting in that flattening of the curve. I'm not sure if that makes sense. It makes sense to me. And we discuss that kind of stuff in the Discord and provide resources, either stuff that I pull up or that I find other places. On the shoulders of giants, a midget can see for miles. I invent this stuff. I, go to a lot of resources and kind of, find stuff that I think is useful. I guess now it's time for me to stop and pass it back to you, Fabio, to pass it back to Patrick. Unless I have questions in there.
Yeah, thank you so much, Doc. And so I think again, Doc and Punk are part of our trading room here, so you can follow it under trade structuring and IC Haven, which is really premium selling, and Iron Condor, so mostly like option selling. We then have a future trading room, which is more like focused for directional trades. So I'll pass it back to you, Patrick, to kind of share how you would go ahead and prepare for a day like yesterday, being a scalper or future kind of like trader.
Okay, yeah. Before we do this, please allow me, Doc, to ask you a question, because we was not asking if someone have questions, and
sure,
I'm 100% sure we have some questions. If not, let me speak for the community, and I have also a questions for Fabio. So let me know if someone has some questions for Doc. Otherwise, I will ask my questions for you, community.
There's one question. I don't know if you want to take it, Patrick, or if you want to take it. Should we expect to see large moves at these levels?
Okay, well, when you say these levels, I'm not sure which levels you mean, but what I will say is, I think of the larger levels as key inflection points, as key points where we're going to stall. Think of it as support or resistance, where we'll have a larger reaction if we break them or stall. And that's where, if you're day trading or scalping or whatever, those are your reaction zones that you're looking for.
All right.
So that.
Okay, great.
All right. So my questions for you, Doc and Fabio, I think this is something what is really important. So, what do you was learning from yesterday, Doc? If you was recap the day at the end of the day, and what was in your mind? What was you learning? What you was maybe not seeing? Where you should be in the future, looking much more deeper into it. Take us in your mind so that we can have something from your learning from yesterday.
Okay, so from yesterday, what I was looking at first and foremost was what was happening to VIX. I want to see what's going on with volatility and how that's affecting the overall structure. Yesterday was not a typical day, so you don't have to look at it quite that closely. And so when I saw that big VIX drop from wherever it was, from wherever we opened at 55, we quickly receded to like 45 or 42, whatever it is. Once I saw VIX dropping, volatility dropping, I knew that those options deltas are going to change. And then market makers are going to have to start buying. So then I'm going to I always look at the volume. Where's the volume coming in? And looking for where those next big level targets were. So 42.50 was a big level yesterday. I think it was 52.50 rather. And we kind of went right up toward it. We kind of went right up toward that level, and we kind of got slammed down. So on a day like yesterday, I'm expecting these wide moves and looking for just where the big levels are to get these strong responses.
Good one.
Does that answer your question?
Yeah, good one. I think it's important to understand for everyone that most of the traders, or let's talk about professional traders, we're looking always to the VIX. No matter if you're trading futures or if you trade options, the VIX is something that's really important for us. And this is something what I can also say. I'm looking all the day long to the VIX, a second confirmation, and it's really important for us how the VIX is working. And yeah, Doc, you confirm this. It's perfect.
Yeah, and now yesterday was an atypical day because, you saw when I did the review of like the VIX complex. Today we have some clearer levels. We know 30, we know 25 going out in time. We have something to look at. Yesterday, the VIX was so nuts that there wasn't even a clear level to look at. 45, 50, it was just, that happens sometime. So they're like yesterday, you just look at the overall pattern. There's not even an inflection point level. Patrick and I, although our approaches are different, we look at reaction zones or blind spots or levels where we expect something to happen. And yesterday with VIX, there was really no level. It was just where is it going and what is it doing?
Yeah.
All right. I think we have 1-2 other questions, but we can do at the end and Q&A for general questions. Let's go to the next round, Fabio. What do you think?
Yeah. Did you have any question for me, Patrick? Or
yeah, the question goes also for you. You are the one who have deep knowledge of the levels. Yeah. What was the main thing for you where you was wondering about the market? So what do you was thinking, man, why we was not seeing this, or was this something what you say, I was seeing this really clearly, or do you was something expected what you can share with us?
Yeah, so I think obviously, nobody can predict like an event, like a catalyst event like yesterday, right? So there's no model in the world that can tell you, okay, the market is going to drop 5%. But by looking at the data, as we showed you before, like those flip points, like those changes from positive to negative gamma, those are always sign of, hey, maybe something is happening here. So like it's a way of, hey, maybe I should really pay attention to what the data is telling me. So I think it's very important that, within your daily routine, you look at, the data, you look at how things are changing, you look at the positioning. So we made it kind of like very, as Doc was saying, like very clear, like green and red, right? So if we use our eyes, we can see very quickly how things are changing over time. So that can tell you like, oh, hold on, why is the picture very different from yesterday? What is going on today? And then you can kind of like deep down and see, okay, let's look at all the other data points that you guys give me. Let's look at the metrics. Let's look at the skew. Let's look at, how the levels have changed. So always look, for example, how the main level are shifting, right? So if we look at, let's go back to the 31st, right? So we see a core resistance at 5,750 and a put support at 5,300. You want to see if these levels are shifting down. So like you want to see, okay, like, is there like a shift in these levels and so on. So as you can see, we see like a lot of the cores were closed. We don't see a lot of green bars compared to the day before. So looking at that is very important, I think. And then, that can give you like an overall picture of what can happen. And then obviously nobody can predict what can happen during the day. But, again, those levels can act like as a support tool for you guys.
Let me quickly interject. I was looking at yesterday's chart, experiencing a little PTSD, and I was kind of remembering what happened yesterday. And I don't know if this is really showing it clearly enough, but yesterday we opened near that 5,100 level, big round number. We undercut it in the pre-market, I think, and then we opened up right near that round number. 5120, I think we opened. So right away, the first thing I'm thinking is, what's the reaction going to be toward this big round number of 5100? And it seemed to hold. We pretty almost immediately shot up to 5150, the next round number. Volatility is coming in. Market makers had to hedge that extreme volatility by selling a lot of futures, because the deltas of those puts, say the 5100s that were a 10 delta when they sold them to people, are now a 50 delta or a 40 delta. So there's a lot of hedging. As soon as the VIX comes in, volatility comes in, they have to start buying. And then we kind of pretty much went level to level up through the round numbers 5180, which I identified as a level for today because that 80.75 level has been a level in this recent sell off. And then we kind of, you see, we went right up to these main levels here, 52.50 yesterday, where we got rejected. And so I'm just looking back at yesterday's chart and reminding myself of where the action was. And then we kind of stalled around 5,200, 5,220, another key level, and got rejected from there.
Sorry to interrupt, but check your DMs real quick.
Okay.
Yeah.
Sorry. If I can add, Doc, those levels were also here. So the 5180 that you mentioned, you see a big red bar here, and then we have the 5150 down here as well.
Yep.
Yeah, I think that's a good one. So if you be a beginner trader or you're trading now for a few years, but you struggle with become consistently profitable, but the wording consistently profitable is really hard. So what is consistently profitable? We will not speak about this today, but the learning what was Fabio and Doc was sharing is really, really important. So Fabio was saying, looking for the flipping. So when the price is flipping from the past to now. Doc was saying simply looking to the wigs. What's going on with the wigs? So if you're looking for this, I think we can prepare not the future, but we can think about what could be happened. And if I go now to the chart, how I'm using the levels, how I'm using the blind spots, then based on this, what Fabio was talking to you and what was Doc talking to you will become much more easy to understand what I'm doing. And now, if you be okay, Fabio, I will be start with the presentation.
Yeah, I just want to say I gotta take off, guys. Everybody, I'll see you in the channels, and we'll be in the channels later. Thanks, guys.
Thank you.
See you later.
All right, let me know when you see my screen.
Yeah.
I will make it as big as possible for you guys. So basically what I was doing, I was replicate the day from yesterday. So today, it's not the levels from today. We see the levels, the gamma levels and the blind spots from yesterday to become really closed off. So technical, what was happened yesterday when we get the down move, we was below the 1 day minimum. But lucky enough, really lucky enough, we have blind spots in play yesterday who was doing a really nice job to guide us through the market. So we can see that the blind spot 6 was holding the blind spot 5 BL average. But this is something what I'm like to see, that the blind spots. So blind spots is we're looking for high correlation because of the ES. So this is something what the blind spots telling us, where we have high correlation, high overlapping. And then when we have something like this, so we can say technical, and this is what I was doing. I was saying based on the levels, so I'm looking only on the chart, only on the levels, and not on what was Fabio doing technical and Doc. I was saying, okay, let's make it funny. Let's drawing a Fibonacci from the 1 day min based on the options gamma levels and the last blind spot on the downside to map out what could be possible happened if we get a crazy down move. And look at this. So I have only on my Fibonacci the settings 0.5, 0.38, 0.62. Why I have this? Because no matter what, if I'm drawing this from the top to the bottom or from the bottom to the top, I have always the same price levels to make it as simple as possible. And if I will map out now the Fibonacci area from the 0.62, what we can see on my chart, to the 0.38, it will become really magic for you. And you can see I was predict a little bit the down move. And we was in this area, and this is something what I will do if we have no levels, no data, or something else in this area. So what I will give you as information, if you have no levels on your chart or no blind spots on your chart or nothing else, so you can use your Fibonacci to predict some areas, what could be happen. So this is only for the ES. The ES was yesterday, to say it really clear, the blind spots was working very well on the ES. But let's take a look on yesterday, what was happened on the NQ. It was not so easy because we have no levels. So here yesterday it was a little bit harder. But what we're doing, so here are the levels from yesterday, exactly what was happened. So we was also going down from the 1-day minimum. After the put support, we have no more levels. So technical, what we can do, and I'm doing always the same, I say to myself, drawing the Fibonacci from put support to the last blind spots level. So we have BL7. Here we go. So this could be some area where we can have possible some target where the stop, where the down move can be end. But if I see that this will be not happen, so we get this before, so then I have a nice and a good point to predict something different. Now I can say, okay, let's draw the Fibonacci from put support to this area and look at this, what I can map out now for a price area. So basically what I will show you here is, so if you have no levels on your chart, so you can do this with simple and easy steps. You can draw your Fibonacci, use your levels, what you have from mentor Q, use your blind spots, and find the way where we can possible stop. No matter if we on the down move or if we on the up move, you have something. Don't tell that you don't see something because you have no levels. You have levels, but you have to map this out. And now let's go to NVIDIA. The same stuff yesterday. Lucky enough, we have also the levels from yesterday, the blind spots levels from yesterday, and the NVIDIA levels from yesterday. Why I say we have the blind spot levels from yesterday? So what I was technical doing, I was using our Mentor Q levels premium indicator, where we have the option to convert everything what we want. So we can basically say, I want convert from NQ, like here, to NVIDIA, and then check mark this, but I will take it out because I was doing this on the other side. And then I will get the blind spots from the NQ on my NVIDIA chart. And if we was looking to this, how magic this was working, you will freak out. So we have here the BL7 from the Nasdaq, and where we was open and get the crazy move from NVIDIA, it was on BL7. So we go from BL7 straight to the 1-day minimum, and the rest is history. What we can also say is, like, we can say, let's take a look, let's drive in Fibonacci from put support to BL7 to get some our areas, what we can be technical, say where we be safe or where we can have the next down move. So, and we are here. So it's crazy. If you have no levels, or if you have the blind spot, or levels are far away from each other, use the Fibonacci's to map out your areas where you really like, and you will find no more blind. And this is something what I want to share with you, especially on days like yesterday. It's possible to find entry points, target points, where we can possible stop, and yeah, use your data. So we make it as simple as possible from Mentor Q for you to have all data available, but you have to use it. And that's the key, Fabio. What do you think? I'm also done now.
That was an awesome example, because yeah, again, when there is no data, there is data. There is tools that you can use to find the data or the insights that you need, and also the community is here to help you as well. So there was a lot of chats going on yesterday in the chat room. So please, use that as well as your tools.
Yes.
Maybe we can, we can do some Q&A. I can answer some of these questions. So a good question from Strada Jones. What skew models do you have and what are the expirations? So if we go back to the bot, we have 3 expirations for skew. If you type in the command skew, you have the normal skew, which is the 1 month, and you can read it here. You have the 3 months, and then you have the next expiration. So for next expiration, if you are trading SPX or QQQ, that would be the 0 DTE skew. If you're trading NVIDIA or any stocks, that would be the next weekly expiration. So you can use those 3 expiration there as well.
So there's from Joel Rosenstock a question. I can answer this in general. It's like, all right. When you are trading futures, how much room do you give your trade of ticks, of points for NQ and ES? So basically, let's talk about in general. It's all about your personal risk management. It's all about your capital. If you have, for example, 1 million under assessed, because, for example, like me, I'm an institutional trader, so I can risk many, many points. Why I can do this? I can say I trade only one single contract, and I can easily risk 50 points, 100 points. But if you are a retail trader and you have not so much capital like institutional, of course, or you're trading for a prop firm and you have different risk management rules, you must think first, okay, what you can do basically based on your capital. So, and you must first looking in areas, what areas you have really interesting in. So basically you say, okay, I won't go for 50 points, but my stop loss could be possible 30 points below. 30 points could be a really big, could really hurt you. Then you have to think about, okay, what can I do to realize the trade? Maybe should I switch from basically NQ to MNQ to have less contracts, less risk on my trades? And should I be average in and average out if something is not working? So there's no general rule. It's really based on your capital and based on your strategy. And this is something what I can say in general to you. It's all about your risk management, your capital, and depend on what you target on your risk side, where you want to place your stop, and what you want target for take profit.
Yeah, that's very useful. All right. Let me, guys, please share any questions here in the comment. There is one question from Maciej. So let's, that's a good one. Let's look at the 5-day and 20-day model. So as we showed before, as of July 16, we kind of like released a swing trading model. And the goal of the swing trading model is to give you an idea of where the price would go at the 5-day and 20 days. And 5 days is 1 week in the future, 20 days is 1 month in the future. So the goal is really to give you a volatility band that could help you first understand where you can make money, but also understand where you should really get out. So as a risk management tool, but then also give you like a potential direction of the model. So if we look at, for example, in this case, let's look at, for example, one that we did last week, right? So this was Intel a few days ago. I think this one was the day of earnings. And then again, the swing model is providing you with an upper band or a lower band and a risk trigger. Those are levels that are similar to 1-day expected move. They go in the future, so 5 days or 20 days in the future. So here was the level for INTC for the August 1st, and the upper band was 31, the risk reward was 27. We then added a bullish or bearish bias by looking at different data sets. We look at options data, we look at momentum, and we look at other kind of like algorithms that go within the model. So essentially, we try to make it as easy as possible. So whenever you see a red band or a red price, there's a bearish bias. Whenever you see a green price or a green level, then there's a bullish bias. So in this case, for example, Intel, really bad earning. The next day, I think the price dropped over 20%. This is an example on how you can use the data. If we look at, for example, the model on NVIDIA, and we look at 20 days, this would be the lower price. So 78 would be our lower band. And the fact that it's green is showing you that we still have a bullish bias based on the model on that stock. I hope that makes it clear.
Yeah, that was a good point. And Matthias Koch have also a great question. I can go to NVIDIA again, because yesterday I was trading personally NVIDIA. Could you please give some examples how you could trade the mapped out areas, trade setups? How do you use the center line of mapped out areas? Okay, so I will do it really quick again. So we will have very, very soon in the Mentor Q room a live trading session where we talking about all the stuff. But let's talk about the basic things. And I will show my monitor again. Here we go. Let me know if you can see it.
Yeah.
Okay, perfect. So again, so to say, okay, what strategy we can have. So technical, what we was doing, we was mapping out our Fibonacci's. So, and I like to map out, and this is something what I'm doing in the morning club, to map out between the areas. If I see something is in the play, like here, I will map out between the 1-day minimum, the BL7, take out the Fibonacci, also here from the BL support to the 1-day minimum, because I want fill the gap with, I want fill the gap with a Fibonacci. Every time when I have a big gap, I fill this with the Fibonacci, and I show you in a little second why I will do this, because then we go to a lower time frame. I scan here again from BL9 to put support, and look at this, what we was mapping out. It's perfect. Here we go. So now you see what we was mapped out. And if you say on the middle line, what is the middle line for people who don't know? I'm using rectangles and I activate the middle line. The middle line is the 50% area. And as you can see on the 15-minute time frame, on the middle line, we was rejected with the candle wick. So basically, what this could be for me and sign, okay, now it's looking for a nice short opportunity. So only like this. So if we're looking to the middle line, but I'm not trading the 15 minutes. So for this, I'm trading the 1 minute time frame. So okay, let's go to the 1-day 1 minute time frame from yesterday, so that we can see what was happened. So we were starting from BL7. So, and this is now only in recap. So if we be in the live trading, we were going through this very, very live. But what we can see when we was speaking about the middle line, my friend, we was seeing, okay, we was holding here the middle line, and we was rejecting here from the middle line. So technical, I see now here on this case that the middle line was accepted from the market, and the middle line was accepted from the market here. Let's zoom in a little bit bigger. And then we can say, okay, basically on our technical strategy, what we really like as a day trader or something like this, if we see that we was rejecting here, where we can go in again, where we can place our short to take some little points out of the market. So, and what we can target. So if we say we was rejected on the middle line, so based on our roadmap, what we was having here, we have here our next target area. So technical, if we use our short, we can target this area and can say, okay, for a stop loss, where we can place our stop loss if the trade goes completely wrong. So make this white that you can see it much better. So we can say we can place our stop loss above this area. So then we was saying, okay, from 120, I don't know, let's say from 102.20 to 103.20, we risk 1 point. To technical can make much more. We haven't risky what easily from 1 to 2, maybe from 1 to 3. So it's this with some plan for me, and this is something what I was doing yesterday. So I was trading like this, and I hope this helps you, and this gives you a little bit more idea what I'm doing. And also, if you want to see the levels, so you can say, here we go, here we have the levels again. But we are now far away, so this is why the levels are not showing here. But technical, this is what I'm doing, and it's based on the Fibonacci. It was based on what I was mapping out for you. And yeah, that's it.
That's
Simple
great.
and useful.
Thank you so much, Patrick. So I think yeah, this was a great session. So a lot of questions. If you guys have any questions, please follow us. You can also reach out to us via email, and please let us know if we can help. But thank you so much for the session, and please reach out. And again, thank you, Patrick. Thank you, Doc. Thank you, Punk, for taking part of it. And we see you back in the Discord.
And thank you for all of you who was joining us. Yeah, so many thanks for your time that you will spend time with us. And yeah, so let me say last words to all of you. If you was liking this, write some comments on YouTube, share this on Twitter, share this in the community, how you was liking this. Give us some feedback. If this was useful for you, we have the member success area. Write something down if you was taking out some notes today from this, so that other people can also take out something who was not able to join us now. And if you have questions, make sure that you send us the questions. If you want more about how to mapping out on stocks like Nvidia or Tesla, Apple, whatever you want, join the 6 a.m. morning club. We will do this regularly. And now let's came to the end, and thank you to all of you.
Ready time. Thank you. Thank you, guys.
Bye-bye.